So here we are in exercise 21-7B. In this particular problem, we've got 2 or 3 different twists. One is that we're accounting for the transaction from both the point of view of the lessor and the lessee. Secondly, we've got a sales type lease. We haven't dealt with a sales type lease in our problem so far. And third, the other thing is that we've got a different discount rate to be used by the lessor as compared to the lessee. So those are the twists in the problem. Let's run through the facts here. So we've got Global Corporation. Global Corporation is the lessor. They are the entity that owns the property and is making it available to the lessee who wishes to obtain access to the property. The lessee is Local Inc. So the lease is a 6-year lease. And no renewal option. The equipment reverts to the lessor at the termination of the lease. That's just sort of an indirect way of telling you that the title does not transfer to the lessee. We've got rental payments are due on January 1st, beginning in 2014. So today is January 1st, 2014. Payments, since the first payment is due today on January 1st, 2014, the significance of that, of course, tells us is that in our present value calculations, we've got a present value of an annuity due and not the present value of an ordinary annuity. The fair value of the equipment is $320,000, and the carrying amount of the equipment on the lessor's in the lessor's accounting records is $265,000. The significance of that is it tells us if this lease is classified as a capital lease from the point of view of the lessor, it's going to be a sales type lease and not a direct financing lease. The reason it will be classified as a sales type lease is because there's dealer's profit. There's dealer's profit present in the transaction because the cost of the equipment to the lessor, $265,000, is less than the fair value of the equipment, which is $320,000. So we're told here that the equipment has an economic life of 8 years, 8-year economic life. The equipment has a residual value of $30,000, but the residual value is unguaranteed. So $30,000 unguaranteed residual value. And the lessee here depreciates their equipment on a straight line basis. Okay, so in setting the rental payments, which incidentally we're not told what the rental payments are, we have to determine that ourselves. In setting the rental payments, the lessor set the rental payments to guarantee a 12% rate of return on the transaction. We're told that the lessee's incremental borrowing rate is 10%, and the implicit rate of the lessor is unknown to the lessee. The implicit rate is that 12% rate that the lessor used in determining the amount of the rental payments. And finally, we're told that the collectability of the lease payments are reasonably assured and that there's no important uncertainty surrounding the amount of costs yet to be incurred by the lessor. In other words, the lessor has basically fulfilled the obligation that they have to fulfill with respect to the leasing transaction here. Okay, so what we're asked to do here is to calculate the amount of the annual rental payment. That's the first thing that we're asked to do. So here's what the with the lessor, this is the logic of the lessor, is they determine the amount that they're going to charge in terms of rental payment. They're going to say, okay, now the fair value of the equipment today is $320,000. Now, at the end of the lease term, the equipment is going to be worth $30,000, and we're going to get that equipment back. But the right to get something back worth $30,000 6 years from now, we need to figure out what the value of that right is today, the day that we're entering into this lease agreement. So the lessor says, okay, well, we want to earn a 12% rate of return on this lease. It's going to be 6 years before before we actually get the equipment back, and when we get it back, it's going to be worth $30,000. So the present value of the right to receive something worth $30,000 6 years from now is calculated by taking that $30,000 and multiplying it times the present value of the single sum factor for 12% rate of interest, n is equal to 6. That factor is 0.50663. So you take the 0.50663, multiply it times 30,000, and that gives you the present value of the lessor's right to get the property back for $30,000 6 years from now. So what the lessor has to recoup from the lessee in terms of rental payments in a present value sense is the difference between what the equipment's worth today and what the equipment's going to be worth at the end of the lease term rolls back to the present by discounting. Or the lessor needs to recoup from the lessee in rental payments $304,801.10 in present value terms. So what the lessor needs to do now is to figure out what lease payment do they need to charge to yield a present value of this $304,801.10. So they're going to set up a little equation where the equation says, I take present value of an ordinary annuity factor for 12% interest rate, 6 terms, multiply that times some unknown payment amount, and I want the result of that product to be 304,808.10, which is what I have to recoup from the lessee in a present value sense in the terms of in terms of rental payments. So if you go to your present value calculator, or you flip to the charts in the in the textbook, you'll find that the present value of an ordinary annuity factor for 12% interest rate, n is equal to 6, is 4.60478. Multiply that times some unknown payment amount and set that equal to what you want to recoup from the lessee in a present value sense of 304,801.10. Solve for the unknown payment amount, and you get 66,192.33. And we're just going to round that to 66,192 for purposes of the solving the problem. Okay, so the payment that the lessor is going to charge the lessee is 66,192. Okay, so now the lessor needs to figure out whether or not this lease is going to be classified as an operating lease or capital lease. If it's a capital lease, we know, of course, it's going to be classified as a sales type lease because there's dealer profit. Okay, so we go through the 4-part test for the lessor. We ask, is there a bargain purchase option? The answer to that is no. Does the lease transfer title of the leased asset to the lessee? The answer to that is no. Does the lease term span at least 75% of the economic life of the asset? The answer to that question is yes, because the lease term is 6 years and the economic life of the asset is 8 years, and that's exactly equal to the 75% of the economic life. So we answer yes to that question. So we know that our tentative answer is that this thing is going to be a capital lease subject to considering the last question here. The last question asks us whether or not collectability of the payments are reasonably assured and the lessor's performance is substantially complete. The answer to both of those questions is yes, based on the facts of the problem. Therefore, since we answered yes to one of the four questions in the four-part test, and we answered yes to these other two questions, the final conclusion for the lessor is yes, this is a capital lease, and specifically it's a sales type lease rather than a direct financing lease because of the presence of the dealer's profit. Oh, as an aside, we also would have answered yes to the question of whether or not the present value of the minimum lease payments are at least 90% of the fair value of the asset, because the present value of the minimum lease payments, 304,801, exceeds 90% of the fair market value of the asset. We didn't have to proceed down and answer that question because we answered yes to the economic life question. But I'll point that out simply for the sake of completeness. Okay, I got a typo here. This should say lessee. So now we're going to repeat the four-part test. We've already determined, yes, this is going to be a capital lease for the lessor. Now we need to address the question of whether this is going to be a capital lease for the lessee. So for the lessee, we only have to consider the four-part test. We don't have to consider the additional question about collectability and the lessor's performance substantially complete. That question only applies to the lessor. So again, for the lessee, is there a bargain purchase option? No. Does title transfer? No. Is the lease term at least 75% of the economic life of the leased asset? Yep, it's 6 years lease term out of 8-year economic life. So we got 75% economic life. So yes, this is also going to be classified as a capital lease for the lessee. Okay, so the entry on the lessee's books which of course is made the day they enter into the lease agreement, January 1st, 2014, is to debit leased equipment and credit lease liability for the present value of the minimum lease payments. The present value of the minimum lease payments here for the lessee is calculated as follows. Take present value of an annuity due for 10% interest rate, n is equal to 6 lease terms, or 6 years rather. That's equal to 4.79079, and multiply that times the amount of the recurring rental payment. Multiply that times the minimum lease payment, 66,192, and the result of that calculation is 317,112. That's the present value of the minimum lease payments from the point of view of the lessee. Notice though that this present value here is different than the present value of the minimum lease payments from the point of view of the lessor. From the point of view of the lessor is going to be using a 12% rate because that's the implicit rate in the lease. That's the rate that they used in establishing the amount of the routine rental payment. So they're going to come up with a slightly different present value of the minimum lease payments than the lessee does. Specifically, they are going to come up with present value minimum lease payments of 304,801. That's what the lessor is going to come up with. because they use a different discount rate than the lessee. That's one of the wrinkles that this problem introduces that you haven't seen so far. Okay, the other entry that's going to be made on the lessee's books on the inception date of the lease is to record the first lease payment. The lessee is going to debit the lease liability account and credit cash for the amount of the first lease payment, which is in the amount of $66,192. Again, there is no interest associated with this payment that has to be recognized by the lessee, because the payment takes place on the very same day that they enter into the lease obligation, so there has been no passage of time and hence no opportunity for interest to accrue on the lease liability. So the next entry to be made in the lessee's accounting records is at December 31st, 2014, when the lessee has to accrue interest on the lease liability. So what the lessee is going to do is it's going to take, let me clear out some space here and then we'll continue. Okay, so what the lessee is going to do is it's going to take the carrying amount of the lease liability in their accounting records at the beginning of the interest period. The beginning of the interest period is January 1st, 2014. The carrying amount of the obligation in their accounting records is the amount they originally credited the lease liability account for, less the amount that they debited the lease liability for in connection with that first payment on January 1st, 2014. The difference between those two amounts represents the carrying amount of the lease liability in the accounting records of the lessee. That's the amount on which interest accrued over the course of calendar year 2014. They're going to multiply that times their incremental borrowing rate of 10%. And the result of that calculation, $25,092, is what they're going to debit interest expense for, credit interest payable. And then the final entry that the lessee makes in their accounting records on December 31st, 2014 is to record depreciation expense on this leased asset. So the depreciable base of that leased asset is simply the amount at which they booked the asset in their accounting records, 317,112, minus any guaranteed residual value. There is no guaranteed residual value in this case, so they subtract zero guaranteed residual value from the amount at which they booked the leased asset in their accounting records, and that's the depreciable base of the asset. And they depreciate that over, in this case, they're going to depreciate it over the lease term of 6 years. If this lease had a bargain purchase option or transferred title to the lessee at the end of the lease term, they would have depreciated this not over the lease term, but over the economic life of the asset, which I believe is, it's 8 years. But that's not relevant here in this case because there's neither bargain purchase option nor transfer title. So we're simply going to depreciate that leased asset over the 6-year lease term. Result of that calculation, debit depreciation expense $52,852, credit accumulated depreciation $52,852. Okay, those are all the entries in the accounting records of the lessee. Next part of the problem asks us to prepare the accounting records in the journal entry in the accounting records of the lessor. And so here is the entry that we're going to make in the lessor's accounting records on the date that we entered into the lease, January 1st, 2014. The basic structure of any capital lease, any sales type capital lease, is the lessor debits lease receivable, debits cost of goods sold, credits sales revenue and credits inventory. The reason that they're crediting inventory rather than some other account is the idea behind the sales type lease is that a manufacturer of an item is using the lease as a means of affecting a sale of their product. So the item that they're leasing here is in effect inventory for them. So the credit entry is going to go to the inventory account. So we're going to credit the inventory account for the cost of the asset in the accounting records of the lessor. And what the facts of the problem up above tell us is that the cost of that asset on the lessor's books was $265,000. So that's the amount we're going to credit inventory for. Okay, the lease receivable account is going to be debited, just as it is in the case of a direct financing lease, by the present value of the minimum lease payments plus the present value of any unguaranteed residual value. In this case, the present value of the minimum lease payments from the perspective of the lessor is $304,801. That's calculated by taking the payment amount of $66,192 and multiplying it times present value of an ordinary annuity factor where I is equal to the lessor's implicit rate of 12% and N is equal to the lease term. So 304,801.10 that's the present value minimum lease payments for the lessor. And then the present value, the unguaranteed residual value, we previously calculated that up here to be $15,198.90. So you take the present value minimum lease payments from the perspective of the lessor, add to it the present value, the unguaranteed residual value of $15,198.90, and the sum of those two amounts is $320,000. That's the amount that the lessor is going to debit the lease receivable account for. The cost of goods sold account is going to be debited by the lessor at an amount that's equal to, let me clear out some space here before we continue so I'll have some room to write. Okay, the debit to the cost of goods sold account here is going to be equal to the cost of the asset to the lessor of $260,000 minus the present value of unguaranteed residual value, which is $15,199. I'm rounding here. That's the same amount that we calculated right up here. I rounded it from $15,198.90 to $15,199 down here. So the cost of the asset minus the present value of any unguaranteed residual value is going as a debit to cost of goods sold. The reason that we subtract out the present value of the unguaranteed residual value here is the logic that is provided in the textbook explanation is, well, since this residual value is not being guaranteed, it's less certain that it's been that will be realized, so we're going to subtract that amount out of cost of goods sold in determining the amount of cost of goods sold to report in our accounting records. The credit to the sales revenue account here is simply the present value of minimal lease payments, which we've already determined the present value of minimal lease payments is $304,801. And again, that's calculated by taking the present value of an annuity due factor for I is equal to 12%, N is equal to 6, and multiplying that times the recurring rental payment of $66,192, and there's our credit to sales revenue. So the entry that the lessor makes to book the capital lease at the inception of the lease: debit lease receivable $320,000, debit cost of goods sold $249,801, credit sales revenue $304,801, and credit inventory $265,000. Okay, the other entry that the lessor has to make on 1/1/2014 is to recognize the first lease payment made by the lessee to the lessor. The lessor is going to get a check for $66,192, so the lessor debits cash $66,192, credits lease receivable $66,192. None of that $66,192 is deemed to be attributable to interest, because there has been no passage of time since the lease was entered into, and hence no opportunity for that lease receivable to generate interest. Okay, the last entry here that we're going to deal with in the accounting records of the lessor is the entry on December 31st, 2014 to accrue interest on this lease receivable. Now, the payment's not going to actually be made until January 1st, 2015, tomorrow, but we need to go ahead and accrue the interest in our accounting records to reflect the interest that's accrued on this note received. And the way we're going to do that is we're going to debit interest receivable, credit interest revenue for the amount of the interest that's accrued on the lease. And the amount to book is calculated by taking the original amount at which the lease receivable was booked, $320,000. That was booked here by that debit to lease receivable. And we're going to subtract from that the portion of this first lease payment that was also made on January 1st, 2014, that went as a credit or a reduction to the lease receivable account. So the difference between those two amounts represents the outstanding balance of the lease receivable that existed throughout 2014 on which interest was accruing, and multiply that times the lessor's implicit rate on the lease of 12%. And the result of the calculation is $30,457. So we're going to debit interest receivable $30,457, credit interest revenue $30,457. So I believe with that we've answered all parts of the question that we're required to answer.